You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. Well, you're watching the market, this volatility, this craziness going on. I mean, just last week, if you were watching, Amazon lost on Friday 14% of its share value, making Jeff Bezos one of the poorest people in the country. No, not really. He's still worth, he's gone down, though. He's taken a hit to his status. He is now only supposedly the third richest guy in the country. And how do you avoid these sudden declines, this obvious increase in volatility that you're seeing in the markets, that if you don't get out of the way, you know, you could be in the position of trying to pick up nickels in front of a steamroller, and you know how that's going to wind up. Well, got a special guest for you, Brent Kochuba. Brent, you are founder of Spot Gamma, an options research service. So with those credentials, I assume you know something about trying to figure out the direction of the market using, I guess, an options-based strategy for doing it. How would you have avoided Friday, or how did you avoid Friday?
Yeah, thanks for having me on, by the way. And it's quite an interesting time in markets, both from obviously the weakness that you mentioned, but also from an options perspective. And as you know, anytime people really get nervous in the market, they look to buy put options for protection, right? To hedge some of their downside risk. And so we look at how people trade put options and what their positions are in order to sort of forecast how much volatility or fear there will be in the market. And what's interesting about this current environment is that the put positions, that is people's hedging position, is as large as at any point since the March of 2020 crash. You can even kind of push it back to the 2018 crashes. So traders in general, from a kind of a macro perspective, are positioned for this drawdown. And I think what we're seeing now is that individual stocks are getting hit pretty hard. So some people are saying, look, they're shooting the generals, right? That's Netflix dropped and Facebook dropped and Google dropped, or excuse me, Amazon dropped, and now people are kind of waiting. You know, is Tesla going to be the last one to really drop down? And so we've gone from sort of there's a big macro hedge out there. People are hedging their S&P portfolios, but now it's about shorting individual names. And that's really what's pressuring the market.
All right. When you started saying they're shooting the generals, I thought you were referring to Ukraine. You know, do you know what the most dangerous job in the world right now is?
I can only imagine something involving being a general over there.
Being a general in Ukraine, it has displaced the former most dangerous job in the world, which was being a convenience store clerk in New York City after dark.
Oh, jeez.
But in seriousness, so the so-called quality, the Fang stocks, those stocks that you followed for years, that you felt, wow, this was. They got something here. They're bear market proof almost, right?
Yeah.
They only go up, Fang stocks. They remind me so much of the 60s when you had this thing called the one decision stock, where you could just buy Kodak, IBM, whatever, hold it for life and retire on your winnings. And we know how well that worked out, don't we?
Yeah, I think Apple is probably the only stock at the moment. Maybe Google. Those are kind of the only two so far that have. I mean, they're certainly off their highs, but you know, those two stocks so far seem to fit that category you just mentioned. Like they'll weather any storm, and you know, we'll see if that's true, I guess.
Yeah, well, you know, it is a market, and like you said, Tesla is still holding. I mean, they took a hit last week, but that was attributed largely to news that Musk was shedding some shares in order to effectuate the purchase of Twitter. But maybe the market had it wrong, huh?
Yeah, that situation is an interesting one because, as you mentioned, Elon needs a $12 billion loan to buy out Twitter, and so he put up his Tesla shares as collateral, or put up some Tesla shares, about $60 million worth of shares as collateral. And we did a video, kind of in-depth analysis of this. But basically, if Tesla stock gets down into the 700s, kind of below 750, you could kind of get in this situation where Elon may end up getting a margin call on that loan. Now, the loan hasn't closed yet because the deal isn't officially closed yet, but that'll be a very interesting situation if Tesla stock starts to slide a little bit lower. And what's also interesting is that a lot of people know this is a fairly public, scenario now, what the loan is and kind of the margin call levels and those kinds of things. And so you always kind of wonder from a conspiratorial kind of just fun perspective to analyze, if Tesla does start to roll downhill, will this selling pick up simply as a fact that people know what his position is and maybe they can squeeze him out?
Yeah, you think it'll become like a meme stock kind of thing?
I don't know about that. I think that one of the problems with thinking that Tesla will fall too far too fast is that it is part of the S&P 500 index. So all the pension money and 401k money and things like that go into the index helps to support Tesla a little bit. And then also there's a lot of funds out there that will trade sort of the S&P 500 as a whole against the components of the S&P. So Tesla's obviously a big component of the S&P. So I think that can help to limit some of the volatility in that Tesla name, meaning that it's harder to move Tesla arguably than a meme stock like a GameStop or an AMC.
That's interesting. Yeah, it's really fascinating time, like you said. Based on what you're seeing now with options positions, particularly you're looking at the puts. If the market's going higher, you probably look at the call options.
Yep.
What is the crystal ball of the put option telling you?
Sure. So we've been highlighting for our subscribers, there's a big date on this Wednesday, and that is the May 4th. That is the FOMC. I'm not sure if this recording will come out before or after that day, but essentially, one of the big worries of the market right now is how many times will the Fed raise rates? And I think they don't really have an understanding of what that is. They're looking at inflation data and the like. So a lot of the tech stocks now are getting beaten up because we have these higher interest rates. And obviously, the big components of the U.S. stock market are tech stocks. Apple and Netflix kind of falls in that category, or at least an interest rate sensitive name. So people have known that rates are going to go higher and they have big hedges in place. And we had this idea of max put positioning. So we're sort of fully hedged, we think, in the market in the S&P. And we have this trigger on May 4th, where the Fed is going to come out and give some guidance. And we think that if that guidance is in line with expectations or even a little bit more dovish, or maybe they won't raise rates quite as much, then that could set up a pretty good rally, just a short cover rally in the market in the short term.
Sure.
And in general, what that would do, that would clear out a lot of put positions in the market. And what that means to us is that makes a second leg or a retest of lows, say in the next few weeks. That makes it easier to take out lows. So in other words, because there's so much hedging right now, it's arguably harder to push the market down. But if the market rallies and some of those put positions are closed or cleared out, then you can have sort of a second leg lower, if that makes sense.
Okay. So you're saying you think there's going to be a bounce, but it depends upon what the Fed says. Do you think the Fed's going to have to back off here at some point, Brent?
I just think if they can give some guidance, so people right now, no, it's unclear. Like it's clear they're going to get a 50 basis point increase on Wednesday. Yeah. Now, are they going to guide and say, hey, look, we may raise 20 more times over the rest of the year, or maybe look, we're only going to raise maybe another 3 times this year. Whatever the clarity is that the market can get. I mean, what the market hates is uncertainty, right? Because all these financial models, whether you're in housing or you work for a pension fund, or you're just a person trying to plan for a purchase of a car or something, you don't know what's going on right now, right? And so that clarity and some certainty, so you can at least plan for what's coming, that arguably makes assets a little safer, right? You can say, okay, Apple's a good stock now because I know that we're only going to get 3 more interest rate increases. So because we have that uncertainty, it drives fear, and that pressures the stock market lower. And if we can just get some clarity in terms of what the expectations are, then that is enough in this case to get a bounce. And that's simply a short cover rally. Everybody here is positioned for Armageddon. A lot of stocks are in a position that is similar to where they were back in March of 2020. And I don't think we're at a March of 2020 panic level at this moment. That was an incredible situation, just from the pandemic perspective, but we also had an energy crisis, right? If you remember, oil was negative, negatively priced for a little bit there. And that was wreaking havoc in the credit markets and the energy space. So at this moment, we don't have that credit like catastrophe yet. It could show up at any minute here. But basically what we think is, again, because the current put positions are so big that we could just get a relief rally, and that relief rally may last for a week or two, and then sort of into the end of the month, then we could kind of retest lows. That kind of, it's sort of a path dependent position.
So how do you make money off this situation, or how do you not lose money, which could be as important or more important, right?
Yeah, we think a few things. One, that because rallies are likely to be what we call short covering rallies, that those are rallies that you arguably want to sell into, right? If you have a very short term view and you're like to trade frequently, then maybe positioning yourself for a rally here over the next week or so can make some sense. But if you're a longer term holder, you can use some of these rallies to adjust down your equity exposure, right? If you want to, trim some of your long positions into these rallies, we think that kind of makes sense because, again, throughout into the remainder of the year, the odds of a recession are increasing and some things like that. So knowing how options are positioned when they hit these maximum bounds, like right now we have maximum puts, that suggests, again, relief rally, knowing that you can possibly sell into some of that rally, sell some of your core holdings, free up cash. And then if the market does drop later, you'll have some money arguably to deploy at lower stock prices. Okay.
So it looks to me like if we're not in a recession now, we will be imminently. We got negative 1.44% GDP growth. And that's only probably understating the actual, the real rate of inflation, right?
Yeah.
So really, we could conceivably be in one already. Might have been in one for a year already, because that the inflation rate is wildly understated.
Yeah, and that's, I think, what the conundrum is here is that you need to raise rates arguably to combat inflation, but you're raising rates into sort of a worsening economic environment, right? And that generally is not going to help things. I think, you've seen mortgage rates increase now sharply over 5, at least for the 30-year mortgage rates. So the cost of capital is going up. And that also affects people in the trading space. Most hedge funds, big funds, trade on margin, right? They borrow money from their bank to trade and invest. And that cost of capital, when interest rates goes higher, the cost of their margin goes higher. And it makes the strategies they deploy in a lot of ways less efficient, right? So the cost of money increasing in general slows the economic machine down. I mean, that's kind of what some of the purpose is. So I don't know that anyone's ever arguably seen higher rates into a recession. And I don't think it's been declared that we've actually had a recession yet, but that was the big fear is we're going to raise rates to keep inflation down. But that's raising rates into a recession. And so you kind of get this stagflationary environment, which is not one that you want to be in.
Would you do us a favor and just define what stagflation is? Yeah. Used a lot. I use it myself quite a bit, and I haven't really gone on to define it because I lived through the 70s. I know what it is. Mm-hmm. But, you out there are probably a little bit younger. You don't know what it is. Just tell us what it is.
Don't just survive. Thrive. The Financial Survival Network.
Osino Resources is a Ross Beatty-backed gold exploration company in mining-friendly Namibia. Osino's district-scale land package is situated near 2 producing gold mines, one of which Osino's management team previously developed and sold to B2 Gold. Osino's founders and management are experienced mining professionals who have already successfully developed and sold 2 companies in the past 7 years. Osino has an excellent shareholder base with Ross Beatty owning 20%, insiders 5%, and Resource Capital Funds 8%. This is an exploration company with drills turning that you'll definitely want to pay attention to. Osino trades in New York under the ticker OSIIF and in Toronto under the ticker OSI. To learn more, go to osinoresources.com. That's osinoresources.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Yes, so stagflation is simply when you have sort of decelerating economic growth and increasing unemployment, and then you're also raising rates. And that's kind of the situation that a lot of people worry about now, because arguably we have very low unemployment at this time, and we've had really kind of booming economic growth off of the back of the Fed. You know, you could argue stimulus and things like that. So we're coming off of a very hot economic cycle. Maybe those stimulus driven or not, it's hard to, I guess it's up to your opinion, but the economy's sort of slowing down a little bit. Unemployment is basically, at the lowest it's ever been here, right? So that is likely to increase. We're going to get higher levels of unemployment now, just off a function of there's nowhere else to go. I think we're pretty much fully employed, right? Again, the economy's been so hot, they're trying to cool that off. So the economy's going to start sliding down, unemployment's going to be going up, and then then we have high inflation, right? And that's what the stagflation is. And the problem with the high inflation is, a lot of people would argue that it is due to stimulus, but there's also some just demand issues, right? If you look at the energy market and what's going on in Europe and also here, we've had energy policies that aren't really supportive of crude oil and natural gas production and things like that. And so
being too kind, you're really being too kind there, Brent. They've been out and out destructive, inhibitory. That's a word. I think it is a word. Really dissuading. And at the same time, price is up, demand is up. And my experience with markets is that even if the government tries to do something, if the market's totally against them, meaning that it's now more profitable than ever, and in the past 10 years, it's now more profitable than ever to drill for oil. You're going to get more of it because the market's going to reward those people unless the government actually puts a gun to their heads and says, literally or figuratively, no, you cannot drill for more oil, right?
Yeah.
So,
and it's not just, I think, in energy where you can see that. I think, clearly China's shutting some stuff down and just, I mean, it doesn't take a genius to understand that when you try to go and order lumber or a new car or whatever it is, people are quoting, months and months and months out. And I don't know that the Fed changing the rate a little bit here or there will have an immediate impact on that, right? It's like a fundamental supply issue that has to do with production and manufacturing, I think, in ways that maybe some adjustments in interest rates don't help that in the near term. So at any rate, what is causing the inflation is not something that a monetary policy could arguably address in the near term, right? Changing monetary policy here is not going to make us pump oil faster out of the ground or get China to ship us, transistors any faster. So back to stagflation, you're getting high inflation and declining economic growth. And that's a position that people don't like to be in, right? Because that sort of worsens the economy, the higher prices and slowing economy.
All right. So let's look at real estate, just as a for instance here. Real estate prices have boomed. They've gone way, way up at record levels in the past year. Rents have gone up at record levels. Real estate at this point still looks like a sound buy, doesn't it?
Yeah, I mean, we don't analyze the real estate market much, but we did sort of a small exercise where we looked at, so the average house, according to the Fed, if you go onto the Fed website, is around $400,000. And so if you look at the mortgage on a $400,000 mortgage, and you raise the rates from 2% to 5%, that's about a 30 or 40% increase in the monthly payment of your mortgage. So I just think personally, you have record high real estate prices and now significantly high mortgage rates. The math doesn't come out that people can afford houses at the same prices anymore. And so, anecdotally now around my area here in Connecticut, we've seen for sale signs are now popping up all over, whereas they were fairly scarce the last year or two. And again, it comes back to a cost of capital issue, right? If the banks get scared or nervous around lending, I think lending standards, probably increase. Again, the mortgage rates are going up. So all those are likely meant to dampen or slow down, I think, activity a little bit. And that just seems to be, I would argue, where it seems like real estate prices are headed.
Okay. Yeah. Well, remember before the last real estate bust, people always said the thing was real estate prices never go down, right?
Mm-hmm.
Maybe not so much here, huh?
Yeah. It's a fascinating environment too, because if you do look at the stock market and the individual components, I mean, there's a lot of names out there, a lot of stocks, like the meme stocks in particular, that, they've been carpet bombed really, right? I mean, they were trading at prices that were 300 or 400% higher than where they are now. If you look at like a DraftKings or Peloton or, Zoom and even PayPal and Facebook, I mean, a lot of these have already been crushed, right? And so you could see sort of those were the high flyers during the pandemic, and those were, those dropped first, right? And now kind of again, those generals are starting to come down. So you can see sort of the dominoes a little bit kind of trickle down here. And again, I think it's normal for markets to have a correction or have some years where there's some weakness. I think there was some excessive valuations out there, and people, were speculating at the far end of the risk spectrum. They were taking a lot of risk. And so, a lot of that is correcting. And I don't know that we necessarily have to have the end of the world here. We could just have what would be a reasonable correction, clears out some of the dead wood, and then you get maybe a more stable market to invest or trade in, in the next 6 months or a year.
And the SPAC segment there, that's gotten decimated too, right?
Yeah. And I think a lot of people, were looking at the SPAC segment saying this doesn't make any sense. The only people that arguably would definitely profit off a lot of these SPACs were the people who are, like promoting the SPACs, a lot of these billionaires, because they would, if you look at the way these things are structured, they make money on the SPAC regardless of whether or not the SPAC succeeds in its in purchasing, another company, and they fulfill their sort of obligations. So the SPACs are another example of excess. I mean, the amount of money that went into SPACs, I don't have the data in front of me, but it's just sort of unbelievable. And I think there's a lot of things like that are just unbelievable, 150, PE ratios, and companies that don't make any money, that are leading. I mean, I think the poster child of this is the ARK fund, Kathy Wood's ARKK fund, which has the most speculative tech positions really around. And that stock now, if you use that as a barometer for kind of the riskiest of speculations, that stock is now down to, kind of pushing the March of 2020 lows. So again, this is kind of there was a large bubble clearly in a lot of activity, right? And what people are doing. And it's healthy in my view to deflate that bubble, right? And what you want to do is sort of deflate the excess without crashing the system. And so I think that's what we're going to find out if that's what's happened. I mean, I think, we've also seen that the government, if the market really crashes, they've continued to sort of come out and offer support to the market, right? This is the Fed put people talk about, where they'll change policies and things like that to become more accommodative of markets when they're crashing. And some people feel like that accommodation isn't there anymore. And I hesitate to believe that. I mean, I believe I want to see it, but
yeah, that's the way I feel. I feel like, a lot of this is psychological, getting in the mind of investors and messing with their thought process, that thing, the decision loop. So you start to fear that they're really going to go this high. But we know that the past 4 or 5 Fed tightening regimes that have been undertaken, Brent, each one, the peak is lower than the one before. Mm-hmm. So they, as somebody once said, in a religious connotation, why is this interest rate cycle different than all the others?
I mean, you bring up a great point, because I think that the most effective policy tool they have, the Fed, is rhetoric, right? Like what they say, and they can talk the market down. And they've been saying a lot of very negative things. We need to let asset prices fall, and we're going to keep raising, and all these kinds of things. And the market now is, the S&P is down quite a bit from its high this year. It's all-time high this year. It's set 70, I believe, all-time highs last year. And so, we've had just an unbelievable run. And so again, I think a healthy correction does everybody good. You used to have a business cycle, right? And that would clear out some of the dead weight and the underperformers. And that was, it's like a forest fire. You don't want kindling there, right? So you want to kind of maintain a healthy business cycle and clear out some of the companies that aren't functioning well. And that builds for more stable base to grow off of. So I'm hopeful that's the kind of scenario we're in. Raise rates a little bit, clear out some of the dead weight, valuations come back down, and it opens up some good investment opportunities.
Absolutely. I think the meme stocks and the SPAC stocks, kind of the epitome of the excess speculation, what Alan Greenspan used to refer to as irrational exuberance. We got we got that in spades, on steroids, or we had up until a couple of weeks ago. And you saw all the markings of this coming, increasing volatility. Do you do any VIX strategies, by the way?
Yeah, so we analyze a lot the VIX quite often, as well as what's called the implied volatility in the S&P 500. And basically, that's just a fancy way of saying how expensive are options. And so what's interesting about the VIX here, the VIX is currently at 35 as we're talking. And there's a fancy little thing called the rule of 16. And basically what that means is you divide VIX by 16, and it tells you how much options traders think the market will move on a daily basis. So the VIX at 34, if you divide that by 16, you come out like somewhere around 2.5. So right now the options market is pricing in 2.5% daily moves in the S&P 500. Those are really big moves, right? To have a 2% trade move every day, change every day in the S&P. So people are positioned for extreme volatility here. And what's kind of interesting about that is if you go back and you look at historical lows in the market, major lows, they occur at the time when there are big options expirations. So as you know, on the third Friday of every month, there's a big options expiration.
X, right.
Yep. The biggest are the quarterlies, which take place in March and June. And that's because big pension funds, big hedge funds have systematic put positions they hold as hedges for their portfolios. So there's really big positions in June right now. And what's interesting about this is that if you look at the March of 2020 low, remember the pandemic was on and we had a huge crash in the market. The low of the market was the Monday after the big March expiration, options expiration. If you remember back in December of 2020, it was a Christmas Eve crash, right? And Mnuchin was calling banks and the repo market was going crazy and all that. That was that was the Monday after a very large December options expiration. And I can name, another 5 or 6 examples of this, right? But if you're going to look for a low in the market, our suggestion is that you would see a big drawdown, right, into one of these big expirations. Again, June is the next largest one. And all these puts being closed oftentimes can lead to a big bounce in the market. So what you're likely to see is VIX spike and the market really crash into one of these big expirations. And that would be an interesting time to start to look for a market low, which is what makes the June expiration quite interesting, kind of in the near term. So if we kind of had to write a scenario, you'd see kind of a bounce over this next week, and then maybe a second leg lower into that June expiration.
Some people refer to the options X week as the real shark week.
It's an interesting thing because, the options market is so large, particularly in the S&P 500, which is, the kind of the global stock market benchmark, right? As well as the QQQ, which is the NASDAQ ETF. And so if you look at the positions in general at this moment, were call positions. Everybody wanted calls last year. Last year was buy each and every dip, right? And buy calls because calls are leverage, and that's how people wanted to play it. And call positions right now are completely wiped off the map. Nobody wants to own calls. Very few people, as you can tell, want to really aggressively buy stocks. I mean, you can tell that by looking at the price action. Where anytime there's a rally, the rally gets sold and stocks just keep kind of chunking lower. So part of our view on the short-term bounce is everybody seems really positioned on one side of the boat, right? Nobody wants to buy stocks. Nobody wants to buy calls. Everyone's scared. Everyone thinks that it's Armageddon. And generally, when everyone's ready for Armageddon, it doesn't happen. You kind of get, you kind of get a quick move the other way. And that's off of just purely positioning.
Hey, the market always seeks to frustrate the majority of participants. And
that's the truth.
True forever. Hey, Brent, really appreciate you coming on. Just tell us, where do we find you on the web? How can we connect with you?
Sure. I'm at spotgamma.com. We write a daily newsletter. You get a free 7-day trial of that newsletter. If you'd like to try that out, you just hit again spotgamma.com. I'm also at spotgamma on Twitter. If you'd like to see some of the notes we put out, we try to put a few messages on there every day.
All right. Excellent. Hey, if you got a question for Brent, you can shoot me an email as well, kl@kerrylutz.com. We'll get you an answer. And don't forget, go to the site, financialsurvivalnetwork.com. Sign up for your free newsletter. Brent, a pleasure. It's great to have you on the show, and we'll definitely have you back.
Thank you. Appreciate the opportunity.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.